Yeah, we continue with depreciation of assets. So we're going to accounting procedures to treat the various elements of depreciation. As soon as an asset is purchased, it is expected that we start thinking about the depreciation value. As soon as an asset is purchased, we start thinking about charging depreciation on the profit made. At the end of the economic life, the asset will be done. We might as well dispose the assets. So which simply means we purchase an asset, it has to be accounted for. We are selling the asset, it has to be accounted for. The assets that we have previously, they have to be accounted for. And these are the procedures we go into when we are preparing different accounts for depreciation. Do you understand the point I'm making or not? A business would have assets, like an existing business. An existing business will have its assets. But as soon as it purchases new assets, it will be added to those ones it has previously. There's a need for account for that. If you are purchasing a new asset, you have to charge depreciation on it, and it has to be recorded. If you are selling off that asset, you have to charge depreciation on it, and it has to be recorded. If it's either a loss or a profit. So whatever transactions we do, when it comes to the purchase of an asset, it has to be treated separately based on different transactions. Are you with me? So we're going to look at how different transactions are treated. And when we talk about transactions being treated, we're simply talking about the principle of double entry. Double entry system. That's the point we're making here. Do you understand? So for every debit, there must be a corresponding credit entry. So let's start anyway. The first one, opening balances. Why do we have opening balances? We have opening balances because the business is in existence. The business is existing before now. So which simply means it is expected of the business to have different assets that will be charged for depreciation. Do you understand opening balance here? Do we understand opening balance or not? So for opening balance, we debit the fixed asset because it's an asset, it's ours, we debit it. Depreciation provided for such assets will be credited. Do you understand the first situation here?
So we receive fixed asset.
We have, this laptop is already in the business. We want to charge depreciation on it. We debit these assets because an asset for the business, we credit the provision for depreciation. Because every now and then, whatever depreciation we charge, we take it away from the profit made from the laptop. Do we get it or not? No. And for our opening balance, we're talking about an existing business. We have an asset, we have a motor vehicle. Let's say we have a motor car, motor van. This is an asset. The value of this asset is a fixed asset, it is debit because we own it. You debit the receiver, you credit the giver, but we are making provision for depreciation on this asset. So the provision for this existing asset, this one we're not just buying it, it's been in the business before now. So we are making provision for depreciation for this. It means we have to credit the provision for depreciation account as we are debiting the fixed asset account. Do we get it? So the double entry system for an existing asset is that you debit the asset account, you credit provision for depreciation account. This is theory. When we do the practical, you understand more. The second one, depreciation charge. Here, I didn't put E. This is not a spelling mistake. This is an oversight. A spelling mistake will come in form of, maybe I'm writing charge, I don't even know how to spell charge. So if I forgot to put E here, this is not a spelling mistake. It is expected of me as a teacher, after 12 or 13 years, I won't know how to spell charge. Even my boy of 6 years will spell charge. But because I'm writing so fast, I might oversight it. And oversight means you forgot it. That is not a mistake. So it doesn't worth laughing at. People make mistakes, but this is not a mistake. It's an oversight. It's on record. I move on. Then, depreciation charge. So I didn't put E. Let's assume I did not put E. Depreciation charge for the period will be known. So when we're charging depreciation, for this accounting here, we need to charge depreciation. The profit and loss account will be debited, and the provision for depreciation will be credited. Now, the assets, the motor vehicle, we are taking it now out for depreciation. It is already in existence. It's a fixed asset. Provision for depreciation account will be credited. The asset will be debited. Now, for provision for depreciation account, because we are taking it into the statement of profit or loss account, the provision for depreciation here, which is credit here, becomes a credit here. Then this becomes a profit and loss account. It's an asset, but we start using that asset. Because we continue to use the asset, what happens to that asset? It starts reducing in value, but we're using it to make profit. So whatever proceeds we make from an asset goes to the profit and loss account. Because the equipment will produce goods that we sell. We are not selling this equipment, but this equipment is producing what we are selling. Does it make sense or not? So, depreciation charge for the period will be the profit and loss account that we're using, that we're going to make sales from, and the provision for depreciation. So you're going to debit the profit and loss account, you credit provision for depreciation. Same as here. The motor vehicle, when we purchase it, we debit, we credit the bank. But in this case, we have the asset. The asset will provide or produce what we're going to sell. So as soon as the asset produces what we're going to sell, we transfer this to the profit and loss account, and the provision for depreciation account still stays the same. It's been transferred from what you have now to what we are using. From what we have, what we are using. Do we understand the second point here? So depreciation charge for the period will be you debit provision profit and loss account, you credit provision for depreciation account. Why do you debit the profit and loss account? You debit the profit and loss account because depreciation is an expenses. Income you credit, depreciation expenses you debit. So you're going to charge this on the profit you make, on your profit. Do we understand this? So we are making provision for depreciation, which means we are creating it. In as much as we are creating it, we are giving provision for depreciation money that will be used against profit. Do we understand here? So for provision for depreciation account, we credit. That is done. Now, when we purchase an asset, we are buying an asset now. We have motor van before now. We are buying additional motor van. So when we buy additional motor van, we debit motor van account. We credit bank account. We just bought it. When we buy it, we're not going to charge depreciation immediately. We're going to start charging depreciation after using it. Yes or no? So as soon as we purchase the asset, the first thing we do, the double entry for that will be you debit asset account, which is motor van, new one, not existing one. Motor van account, and you credit the bank account because the bank account is where you're paying the motor van. Your bank account is where you have your cash. As soon as you buy an asset, you have to debit your bank account to credit, you have to credit your bank account and debit the motor van account. Do you understand or not? Debits the receiver, credit the giver. Right? The asset purchase motor van. Yes or no? So the asset, now we have motor van. How do we have motor van? We're able to have motor van because we bought a motor van. So it simply means we are paying from our bank account. So the asset of bank reduces. The asset of van increases. Do we understand the purchase of an asset here? So the purchase of an asset will have a debit for that asset, credit for the bank. Any question about this? Any question? Shall we move on? Now, the asset will be used through year in, year out. So we're going to have the economic lifespan of that asset. So as soon as the asset has gotten to the residual value, it simply means it cannot be useful as it used to be useful. What can we do with it? We don't leave it there. We dispose it. We start thinking about selling the asset. It has finished its economic life. So we can't keep it anymore. We sell it to have money. Then we can buy a new one. So what do we do when we want to sell? Well, as soon as we plan selling an asset, we have the disposal account. So you debit the disposal account, you credit the fixed asset account. Motor van is going out now, yes or no? We are selling it. Because we are selling it, it's a credit. So whatever we receive from it is in the disposal account. So we're going to have disposal account.
And get the chair.
Yeah, sure. We're going to have disposal account and fixed account. The fixed account is about what? The motor van that we are about to sell. Do you get that? Do you understand this or not? You don't get it. We have the asset, right? The asset has finished its economic life. Oh, it's expected to use 5 years. After 5 years, either we leave it there or we sell it. But we're not going to leave it there wasting. We can at least sell it. So if we are able to sell it more than the amount of depreciation on it, that means we are making a profit. And if we are selling it less than it, we're making a loss. But the point is, as soon as we start thinking about selling an asset, we have to open a disposal account.
So when you sell something, you put it in.
Yeah, it's disposed, you're selling off. So disposal account will be opened. So as soon as the disposal account is open, you debit disposal account, you credit the motor van account that you're selling. Do you understand up to here? Any question about this? So this will be charged on the cost price of that asset. Now, accumulated depreciation to the date on the asset being disposed of. So remember, each year that passes by, there's depreciation. Yes or no? So each year we have 75, 75, 75, 75. So the accumulated depreciation will be 30,000. So you have to charge it on the accumulated depreciation. Do we understand what accumulated depreciation is now? The total depreciation from year 1, year 2, it's accumulated. That is accumulated depreciation. Do we understand accumulated yet? No.
No, it's not.
Depreciation is charged in year 1, year 2, like we did earlier. 75, 75, 75, 75. When you add them together, they are accumulated depreciation. Each year is 75. Year 2, 75. Year 3, year 4. When you add them together, they will give you your accumulated depreciation. So for accumulated depreciation, you debit the provision for depreciation. Now you credit disposal account. You know we want to sell the asset, right? If you are selling the asset, you have to think about the van that you are selling and the disposal account. As soon as you are going to sell it off, the disposal account becomes your credit. Then the amount of money you're going to make here through the depreciation becomes the debit. Disposal account is, you are opening disposal account because you want to sell an asset. For the debit entry, there must be a corresponding entry. Why do you open the disposal account? You are opening it because you want to sell a motor van. So you debit the disposal account, which is open. You credit motor van account, which you are about to sell. You want to sell the motor van. Disposal. You can't sell it and put it in your statement of financial position or statement of profit or loss account. You have to open a ledger for it. So the ledger account for disposal of assets is going to be disposal account debit and the asset account credited. Now this is going to be done. We are selling this off. Yes or no?
Yes.
So to sell it off, we have to think about the accumulated depreciation on this asset because the motor van has its depreciation. We have to calculate all the depreciation on the motor van and make the provision. So the depreciation will be provision for depreciation account. Now, the disposal account, we are disposing this, so it has a credit. We are selling off. You credit the giver, you debit the receiver. You are crediting disposal account now, yes?
So we're giving away the disposal account for the motor van.
Yeah, motor van is going to be disposed now.
So we give it away.
Yeah. So we give it the motor car away. Proceeds on sales. Whatever, as soon as we sell the motor van, we receive cash, yes or no? The cash we receive will be debited in the bank account. We are disposing an asset. You gave cash, you gave the car out, you are receiving cash. This is the motor van that is being disposed of, right? We are disposing this off. As soon as we dispose it off, we receive cash, yes or no? The cash will be paid into the bank account. So, you debit the bank because you are receiving cash. You credit the disposal account because the disposal account is disposing the car. Differences on disposal. Now, either you make a profit or you make a loss. When you are disposing of the asset, it's either you make a profit or a loss. So those are the two situations. So, how do you know if you make a profit? If the debit side is greater than your debit credit side, you're making a loss. Because it means your expenses is more than your income. Stop that already, please. Are you guys with me, please? Differences on disposal. Either you have debit greater than credit or credit greater than debit. So if your debit side, if the debit side is greater than your credit side, you are making a loss. So for the loss, it is an expenses for the business. So it goes to your profit and loss account. Because you're making a loss, you debit profit and loss account, you credit disposal account. So on the sales of assets, you sold the asset, right? You sold the asset. It's still on the credit. So the sales of your asset is bringing a loss. So but when you sell, because you are selling, it's going to be in your profit and loss account because it's sales. But what sales is it? Is it an income or an expenditure? It's an income if you make a profit from the sales. And when you're making a profit, it means your credit side is greater than your debit side. If you are making a loss, it simply means your debit side is greater than your credit side. So here, if the debit side is greater, you are making a loss. You debit profit and loss account, you credit disposal account. If your credit side is greater than your debit side, it means you have more income, you have made a profit. As soon as you make a profit, you credit the profit and loss account, you debit disposal account. Because here, you receive income. So your profit and loss account, additional money has come into your business. Here, you are spending more. Because when you have a loss, it means you are spending more. When you have a gain, it means you are having more. So as soon as you sell an asset, the account that you have to open is disposal account and profit and loss account for the sale of an asset. Then what happens to your disposal account, what happens to your profit and loss account will depend on if you are making a profit or making a loss. Do you understand all the procedures here? So these are the theoretical aspects of preparing depreciation for an asset. Now we're going to go to the practical in the next class. Is it clear? Thank you.